Holy flippity flip flop flap and smokes, everyone. A major bank has just started failing today, so it's time for me to crawl out of retirement and post another video because you need to understand exactly what is happening right now. But not just what's happening in the banking sector. The Federal Reserve made some shocking statements today. The stock market tanked on this news. We're also going to cover what's happening between the Biden administration trying to start World War III with Iran. We're seeing the escalation in the Middle East continue to escalate every single day. We're also seeing the border crisis, what's happening with Texas, and much, much more. So everyone, this is going to be a very action-packed episode. I'm going for less frequent content, but more quality content. So it's definitely going to be a good one. So you know what time it is. Let's get straight into the news, the facts, and the data. So okay, first story, what we're going to talk about today, everyone, is what the Federal Reserve just did and what they just said. So the Fed holds rates steady indicates they're not ready to start cutting. Now, the markets did not like this at all. They were all hoping that the Federal Reserve will start cutting immediately in 2023. I said there's no way this is going to happen. Inflation, yes, while it is coming down, prices are still very high. Prices are still going up. They're just not going up at the same rate as they were in 2021 and 2022. And also, if the Federal Reserve started cutting interest rates now, started printing money again, then they run the risk of inflation surging again. So let's get into some of the dot points here. So the Federal Reserve sent a tepid signal that it is done raising interest rates, but it made clear that it's not ready to start cutting. The Federal Open Market Committee removed language that they had indicated a willingness to keep raising interest rates until inflation had been brought under control and was on its way towards the Fed's 2% inflation goal. However, it also said there's no plans yet to cut interest rates with inflation still running above the central bank's target. So all these people that were, betting on the market booming because the Federal Reserve will cut interest rates to zero again in 2023, I don't think that's going to happen at all. Maybe they may do a few cuts towards the end of the year, but the reason they do this is going to be because the economy, I think, will be in an official recession. We all know this economy has been struggling. We got the latest jobs data out today that there was only 107,000 private payroll jobs added. That was below market expectations, and the jobs market is finally starting to cool. So if the Federal Reserve does cut, it's not going to be because of a good reason. It's going to be because of a bad reason, because the economy is falling, and that is not good for the stock market. Because if we have a look here, the Dow is down around 300 points. The SPY is falling. I like that meme. The SPY, that's the S&P 500 index, that fell 1.6%. The NASDAQ down even more, which normally happens when there's a risk-off environment. When things are bearish, the NASDAQ tends to fall more than the S&P 500 and the NASDAQ. Also, we can see the bond market has been hovering around the 10-year US Treasury yield between 3.9% and 4%. Oil, though, has been rising over the past month because of the escalations with what's happening in the Red Sea, with what's happening with the Iranian-backed militants, and what's happening, which I'll go into later in a moment, what Biden is doing with that. Also, gold is still holding strong at around $2,057 an ounce. Bitcoin still, obviously, again, same like the NASDAQ. Bitcoin tends to sell off more when there's bad news for the markets, but it's still holding pretty strong around 42,500. So I know what you're all wanting to know. Okay, well, what is this new bank that's failing? Why are they failing? And is this going to cause domino effects for other banks to fail? So let's have a deeper look, everyone. But first, a quick word on today's video sponsor, Delete Me. Now, ladies and gentlemen, as a digital creator, I'm always online, and that made me think and worry about how much of my personal information is out there. It's a bit scary, right? And that's why I want to introduce you to Delete Me, a service I've been using and genuinely trust to protect my online privacy. So what's the deal with data brokers? These companies collect and sell our personal information like name, addresses, and even data about our families. This can lead to serious issues like identity theft, unwanted spam, or worse, doxing and harassment. I know the feeling of vulnerability, and that's why I turned to Delete Me. They're not just a service, they're like my personal privacy guardian. So here's how it works. You sign up, submit your info, and experts get to work. They search for and remove your personal data from countless data brokers, and the best part, they keep monitoring and removing it throughout the year. In just a week, you can get your first report and it will shock you to see how many places your information is stored and how much Delete Me can clear out. We're talking phone numbers, addresses, and even old social media posts. I'll be honest, seeing my data out there was unsettling, but seeing it get deleted was incredibly empowering. And it's not just me, my family's data and information is safer too. And I really want you to experience this peace of mind as well. So here's a special offer. So use my link, joindeleteme.com/Cowan20 and use code Cowan20 to get a major 20% discount. Now is the time to take control of your online privacy because your digital footprint matters. And with Delete Me, you're not just removing data, you're reclaiming your own privacy. Trust me, it's worth it. Check it out and let me know how it goes. Thanks for Delete Me for sponsoring this video. Now back to the content. New York Community Bancorp drops its real estate risk jolt market. Now, this is something I've been warning about, and like Evergrande, I warned that 2 years ago, and now they've finally collapsed. I tried to warn people in advance of things that will come, and I know people get impatient. I'll warn them, they'll want it to happen the next day, but within the markets, things take time to play out. So the reason why this is, and I'll get into in a moment how much their stock crashed, it did crash around 45% at one stage. Loan loss provisions saw on sign of weakening credit quality. Why is credit quality weakening? It's because the consumer is weakening, because the economy is weakening. The bank is also bolstering its balance sheet for stiffer regulations. So also some of the new regulations is going to hit these banks as well. So New York Community Bancorp, one of the winners as regional lenders, struggled and collapsed last year, plunged by record as investors worried it's now the harbinger of the industry's next source of pain. And what is that? Commercial real estate, what we've all been talking about, everyone. The firm, which acquired part of Signature Bank last year, stockpiled cash as it contends with lending risk, including a pair of troubled loans for co-op complex and office space, as well as stiffer regulations due to its size. And the bank's provision for loan losses surged to $552 million, shocking analysts and shareholders. So even these analysts and shareholders were caught off guard, and that's why the stock fell as much as 46% today and was down 38% at the close. Now, I thought this was very, very interesting as well. The amount of the company's loans that were 30 to 89 days past due jumped 48% in the last 3 months of the year. So that shows you people are not in a better situation. The economy is not going great. People are doing really tough, and I think it's only going to get worse this first quarter after all the credit card debt piles up from the holidays. So the markets are very worried about what the Fed's going to do. The banks are still not in a good position, but we also have to look outside the box in the markets. We have to look what's going on with the geopolitical landscape, what's going on with the political landscape, because that can change things massively. Look at this. Biden files response at a time of our choosing after 3 US troops were killed in a Jordan drone attack. And my heart goes out to those troops' families, and I'm grateful for the service that they did. But this is another major escalation, and you can see that the Biden administration desperately is attempting to try to make this conflict in the Middle East much, much larger. And that is another big risk we have to watch out for, because if there's more black swan events, we're going to see oil surge even higher, and that's going to make inflation worse. And then that could mean that the Federal Reserve doesn't cut like they're talking about now, and they don't even cut at all in 2024, and that could be more pain for the market. So that's something we have to keep an eye on. Now, also another risk, something outside the box, but that not many people are really, paying attention to in the markets. The IMF warns AI to hit almost 40% of jobs worldwide and will worsen overall inequality. Now, a lot of these AI shills or the big tech guys are going to say it's going to be so great, it's going to change your life. You're not going to have to do anything. A robot will do everything for you. You'll get your little, check, maybe $500 a month or $1,000 a month. But $1,000 a month by the time AI comes out in 10 years will not even probably cover your monthly grocery bill. Okay, the IMF assessed the potential impact of AI on the global labor market and found that in most cases, AI is likely to worsen overall inequality. The analyst comes as business and political leaders from around the world gather at their secret should I say, top evil meeting, I guess it's been called now, the World Economic Forum in Davos, Switzerland. Now, it's very interesting what they did this year at Davos. They invited the Argentinian president who grilled them. They invited the man from the Heritage Foundation, which grilled them. because their main goal at this Davos meeting was regaining trust. Because we all know nobody trusts the World Economic Forum. Nobody wants these unelected officials telling us what to do. Nobody likes how controlling they're trying to be. And pretty much nobody believes anything they say. So they got no credibility. They got no trust. So they're desperately trying to get that trust back by saying, look, we're inviting some of these popular conservative figures, these right-wing figures, to try to regain the trust. Don't trust them, people. They're not dumb. If I was them, or if I was in their shoes, I would be doing the same thing. Okay. So I don't believe it for a second. I think what they are doing is they're trying to take their foot off the neck, I guess you could say. Try to give some conservatives, some right-wing people, or I guess you shouldn't even say conservative anymore because the left has gone so far, trying to give them some breathing space to think that, okay, we're not going to do anything anymore, and then they'll wait to strike again. So I know what you're thinking, everyone. Well, okay, what does all this mean in simple terms? What this means is, everyone, the Federal Reserve may not cut in 2024. We may still see inflation surge again if this conflict turns into World War III. I don't think that's going to happen. I hope it doesn't happen, but that is a risk we have to pay attention to. The banking industry is still not fine. I think commercial real estate will be the black swan event that will bring more banks down in 2024 and could cause a flash crash in the markets if we see some of these large commercial real estate companies go down. And again, we have to pay attention to what's happening in the labor market, the economy, what's Biden going to do, what's going to happen when Trump gets in. I think that could actually be bullish for the stock market. But what do you guys think about this? Let me know down below. You're awesome. I'll see you all in the next video.